Yesterday, two different clients reached out to me and asked me a little bit about my perspective on the markets. And I haven't given market updates on this channel in a while, although if you're interested, you can follow me on Twitter, and I often put comments there, but I'm pretty good at calling tops and bottoms. There's a lot in between that is hard to call, and I think that most of the time it's difficult to tell what is going to go on. But today I'm going to talk to you a little bit about my thesis on what I think is going on and what we can expect over the next several months, and more importantly, why. I'm going to discuss with you an interesting perspective on examining the markets, which is different from technical analysis, different from fundamental analysis, but I think actually to some extent, if you can sort of pay attention to it, may actually help you to improve figuring out whether we're at the top somewhere or the bottom somewhere. If you don't recall, back in, I think it was May 9th, 2021, I had posted a video talking about how I thought the markets were about to go down quite a bit. That turned out to be a really good call. This was in crypto. And since then, I've done fairly good on a few of these other different calls, which again, you can go and see on Twitter. So this does not mean that I will be right in this case. I absolutely could be wrong. Markets are unpredictable and often designed to get the most number of people thrown off. But I think to some extent that is what helps us to figure out what are, let's call them like reasonable probability bets. So I'm going to discuss that with you today. And if you're interested in checking out, like I said, go and check out my Twitter. You can follow me there. And among other things that I talk about, all sorts of jargon and nonsense, I will occasionally post things that I think are kind of good call points. So let's dive in. And before we do though, I'd like to hear from you guys. So put in the comments below what you think are the market outlooks over the next, let's call it month, 6 months, year, 18 months, whatever, you know, that sort of perspective, and where as a result you think is the best place to be allocating your money. Let's dive in. So what you will notice is I famously said that I was buying high risk assets. This was in, I guess, October. And then throughout the period kind of leading up till now, I was mentioning that I had been kind of dollar cost averaging in. I posted on Twitter in December, sometime shortly after the FTX collapse. And I believe in one of the videos, I mentioned the idea that I was fairly heavily allocating at that point in time. I saw signs that things were probably near the bottom. And then I was mentioning to a bunch of people late in December that the sentiment to me struck me as extremely bearish, no optimism, and therefore must be the lows. Now, I did not expect that the prices were going to reverse as quickly as they have. And to be fair, you know, we've seen, yes, pretty substantial rise in certain assets, but on the other hand, there's no reason that we necessarily have to have continuation. And there's some people who are suggesting that we will not. I think they are probably mistaken, but I also think the bulls are probably mistaken. And this comes down to something we call the echo bubble thesis. This is not my term. This is borrowed from some other people, but we're going to talk about it today. And what is an echo bubble? An echo bubble, I think, should be separated a little bit from a dead cat bounce, or separated a little bit from a bear market bounce, which sometimes people refer to. So if you look at kind of the decline from the highs in late 2021 down in early 22, you would have prices go drop a lot, then they would rally up, then they would drop a lot, then they would rally up, and they would kind of go down. And each time you have this kind of lesser bounce. I would consider an echo bubble to be somewhat different from that. And so to understand this best, we should look at the crypto charts of 2017 through to the end of 2019 or so, okay? Easiest is just to look at Bitcoin and you will get a sense of this. So what is different between an echo bubble and a bear market bounce or a dead cat bounce? To me, the difference is that you're actually going to put in higher highs. When you look at a chart, normally what they'll say is you're in a downtrend when you're making lower highs and lower lows, right? So you were high, you go low, you come up, but not as high, you go low, now lower, you come up, but not as high, etc., right? So that's the idea of a downtrend. An uptrend is, of course, the exact opposite, right? You make higher highs and higher lows. Now, what we would traditionally think is okay, the trend has reversed. We're in an uptrend now when we go from higher or lower highs and lower lows to higher highs and higher lows. My comment would be that an echo bubble, that's true. However, it's not going to return to the previous level, and that's why we call it an echo, right? So if you look at what happened with Bitcoin in 2017, you saw the price run up to around 20,000 before crashing down to about 3,000 by the end of 2018. And then in 2019, it went up from about 3,000 to about 14,000 before going down a bunch again. And of course, this does not have to happen again. It is entirely possible that one of two things holds true. Either from here, we go down and we make new lows, possible, or that we get into a situation where the market goes up and it just continues to go up. My belief would be that that will not happen. My belief is that we're likely going to have this echo bubble. And so the idea of the echo bubble is that we will probably see a fairly significant run, although not in a straight line, right? It's not like you go from 14,000 to 32,000. It's more like you go 14,000 up, then you pull back, then you go up, then you pull back, and you put in a series of higher highs and higher lows until you get to some point. Now that point notably is dramatically lower than the previous high, right? So you don't reach previous highs before going back down. And I would expect that we may not see new lows again. So in other words, whatever the prices were, the bottoms that we saw in a lot of these assets in 2022, we may never revisit those again. So this is not necessarily a statement that we will or will not. I think it's likely that we do not, but we'll see. It depends on the asset, of course. Individual assets will perform differently. Some things are pumping now that are basically garbage and are going to go down, and other things are probably going to sustain a little bit higher levels. So the question that a client asked me was, he said, I don't necessarily disagree with you, but why do you think that we wouldn't have continuation? And somebody on Twitter made a similar statement. I commented that I figured we would see a run, but that we would probably not have continuation. And they were saying, well, what would it take for you to believe that we were going to have continuation? So let's just talk about the macro environment and the price moves. And a thesis that I have about how prices move and why it is that you can have some sense for what will go on at certain periods of time. And I talked about this a little bit in the wake of when I posted the video on May 9th, 2021, so you can go back and look at that. And there was another video shortly thereafter, after things went down, that I tried to explain my reasoning of some of the different things that I was looking at the time. So the basic thesis is that things move within a pattern of structural instability, from stability to instability. And you can just sort of understand that when things are unstable to the downside, right, or unstable to the upside, you will tend to have mean reversion, okay? Or as I would call it, you will move towards stability. So what somebody will ask is they'll say, okay, well, if the market was bottomed in sometime in 2022, depending on the asset, let's call it late 2022 in most cases, but some earlier. For example, Ethereum bottomed in like June. So the market went up, great. If it goes up from here, why should that stop? Why are we so confident that things will not just continue on to new highs? Which is kind of, again, my view is I intend to sell into the rally, okay? Might be wrong. The risk is that you miss out on a whole heck of a lot of upside, but this is my view on it. And so since you're watching this channel, I guess, you will listen to my view. And I would love to hear your view. So the idea is when things are really bad, when things are really sold off, you do not actually have a lot of instability to the downside. In fact, quite the opposite. You kind of hit a hard floor. And this is basically just due to selling exhaustion and sentiment, right? The sentiment is so negative and you have so much selling that, like, what are you doing? I saw this in December and I was messaging a bunch of friends and I was saying, what are you guys seeing? Like, what's the sentiment check? Because I'm talking to people who are pretty diehard bulls, who are running projects, who are doing serious stuff. They're long-term in these types of investments, and they're selling, and they're selling solid assets. And to me, that's just hyper negative. On top of this, I go on Twitter and I see all these statements that are super, super negative. I don't see any real positivity. And that to me is just peak, you're done. Like, you can't go down further, because the question is, where are the sellers going to come from, right? We have to understand that markets are made up of buyers and sellers. And so you can have sellers for essentially two reasons, right? The one is they lose confidence or need money somewhere, and maybe kind of there's an overlap here. So they lose confidence, they want to get out. The second is they get liquidated, right? So they want to hold, but they're liquidated, and so hence they're forced to sell. And either of those situations can happen. And by the way, liquidation doesn't have to necessarily be trading on margin, although that's the more common way of doing it. It could be because of the fact that there's something else going on in their life, in the economy, that requires them to sell, right? So a believer is forced to sell because they're liquidated, or else they cease to be a believer, and this drives down pressure. I guess what you could also say is that there is people who are selling deliberately because they think it's going to go down, and that's kind of the opposite. They're sort of doing an inverse investment, as you might say. Okay, so pushing things downward. Fair enough. These are the reasons that this can happen. And there's only so much of that can happen. There's only so many players in the market. There's only so much money. There's only so much activity. And it's counterbalanced to some extent by people on the other side, right? Which brings us to the other perspective. Why is it that people buy? Well, people buy because either they believe it's going to be worth more in the future, right? That's the one way to look at it. Or second of all, they're in a situation where they're liquidated and hence they're forced to buy in order to cover their shorts, right? So these are the two different things that we're going to see. And I think this is really, really important to understanding where the structural stability and instability comes from. So let's just put it into context. Right now, we've just gone through a year of pretty much all negative news or all downside, right? You topped in 2021 across a lot of these assets. Granted, oil and gas and things like that did well into 2022, but we'll call it the risk-on assets were definitely at their highs in 2021 and crashed down afterwards. And it was a pretty continual crash with various bounces along the way. That's a long period of people who were believers exiting, and that's a lot of pressure that liquidated many, many people. So hence, what you do is you just wash out most of the people who can get liquidated. They're mostly gone. And most of the people who can have their faith shaken have had it shaken. It could still happen more, right? There's still, you go farther down, you can get extreme liquidations, etc., but certainly much less than there was. At the same time, if you think of somebody who's making kind of an inverse investment, right? Let's just use Bitcoin as an example, but it's true of the NASDAQ, it's true of Shopify, it's true of Expedia, it's true of whatever entity that is out there that you're talking about investing in, okay? So at some point you might say, hey, this is a great inverse investment, meaning I see that there's a lot more downside than there is upside, so I'm gonna bet on the downside and try to take the asymmetry that way. Well, when it's very high, the asymmetry seems really good. So you can get a lot of people pile in on shorts. But the further down it goes, the less those asymmetries start to make sense. You start to go, ooh, this isn't really so sensible, so I'm gonna come out. So hence, you just have, the pressure is off, right? And there's some sort of an equalization place in between, and it will tend to go past that equalization place for all these different reasons, as well as the fact that people who are good traders and speculators understand that the market will act reflexively, and therefore it will overshoot on either side, okay? Not always, but often. Certainly at the extreme ends of the curve, it will overshoot. And so that's the time to get out. Now, what happens is you have essentially the same, let's call it global macroeconomic setup. Okay, if you just look at, okay, the prices in late December were low, they've shot up a lot throughout January. Okay, what changed? Not a lot changed, really. I mean, inflation was already on its way down. Okay, inflation went down. Earnings haven't shot up, although things went fairly well in Christmas. We've seen kind of increased layoffs in various different businesses coming into the new year. For example, the banks. Companies haven't all of a sudden got some huge injection of capital. You haven't suddenly got, a Fed pivot. In fact, you haven't even had a Fed pause. You haven't had a bunch of stimulus. So why has the market reversed? And the answer is, it was so down here that what you got was a sort of structural instability to the downside, which made it fairly likely to whipsaw back. Now, how fast, how far, that's a whole other question. But the point is, you can pay attention that just when something's been beaten down long enough, hard enough, you're going to have a rebound to some extent. And that rebound typically comes fairly quickly, meaning the move is fairly large in a relatively short period of time. Now, that move at that point in time, although in the very short run has structural instability, so in other words, this week we're going down, or we're experiencing weakness. Certainly you don't have the strength that you had in January. Although that's the case, you're in a situation where that's kind of a short-term thing. That hasn't changed the fundamentals. So if you look at Bitcoin going back to 2019, we kind of figured was through the lows and the highs, it sort of settled out around $6,000. You could kind of figure out that if it was below $6,000, it was probably a good buy. It wasn't obvious that that was the case when it first went down to 3,000, right? Because it's overshooting, but you don't know exactly where it's overshooting by. So when it rebounds and it comes up and it goes down and this sort of thing, you kind of get this sense of like, okay, 6,000 is like a pretty reasonable price point. The same is true as we go up. So what's happening right now? Based on kind of what I'm observing people start to feed into the hype cycle, right? They start to believe, oh my gosh, we're going for a new bull market. Holy man, things are going to pump. And I'm seeing examples of where someone will post a ticker symbol saying, hey, it might pump, and the next day it goes crazy. And this is just sort of abnormal, structurally unstable behavior. Okay? Now, this does not mean that it's just going to die suddenly, but what it does mean is that you can see the startings of new momentum where people don't want to miss out. And this is very different than what you had, say, throughout a lot of the summer, right? Or kind of the fall. In that period of time, you didn't see a lot of this like, hey, we need to jump on it because things are going to go. I don't want to miss out, right? As soon as you start that cycle, what's going to happen? What's going to happen is people will start to lever up, right? First they'll start to get in. And when they start to get in, they'll then say, well, I missed out on the first of all, I'm getting in because I don't want to miss out. And then once I get in, I'm feeling like I missed out on a bit and I don't want to miss out. I don't want to miss out on what happened from the last time. I want a revenge trade. I want to make my money back from before. And because of this, I'm going to apply leverage. And oh, look, I'm making money. And the more money that I make, the more money that I can borrow to put on leverage to do more of it. And it sort of gets its own psychological flow of itself. Now, what's the problem with this? The problem with this is that the fundamentals haven't changed, right? If I think about the general macro environment of what is likely to come up in sort of the spring to summer, the Fed is probably going to pause. Okay, that's good news for people, but keep in mind that markets top on good news and bottom on bad news. So, good news might not necessarily be that good. It might be, a buy the rumor, sell the news sort of expression. But, you'll probably have a bit of euphoria leading into a Fed pause, right? Just because it's sort of affirming what people think. Similarly, inflation is likely to come down on a year-over-year basis simply due to the roll-off effect from the previous year. So you're expecting to see more of that, right? So you're like, okay, great, we're going to have some good news here. But then what? Then what are you left with? It's like the markets have already pumped. And so what is the new thing that's going to cause them to pump higher? And keeping in mind that the higher it goes, the more insane it has to be in order to justify the next pump, right? Yeah, you can get sector rotation. You can say, okay, well, which one hasn't pumped? Let's run into that one, hoping it's going to be the next one that's going to pump. And so that kind of creates a self-fulfilling prophecy of things pumping. You can have all that sort of thing happen, right? But at the end of the day, the fundamentals are pretty the same. And the pretty the same thing is, all right, interest rates are still high. I'm just putting pressure on people who suddenly have to make payments. Companies that were running out of money before are mostly still running out of money and are going to be in a situation where they're going to have to shut down, go bankrupt, lay people off. You're likely to be in a situation where now you have the war in Ukraine firing up again. We'll be kind of through the period of time when things were shut down. War will start up again. This is going to create new uncertainty. Right? You're going to have a bunch of stuff. Maybe this is going to result in some sort of new spike in energy prices or food prices or something like that, which might bring back fears of new inflation, which might bring back fears that the Fed is going to tighten again, et cetera, et cetera, et cetera, right? Like there's all these different things. There's all this bad news that can just naturally show up. Now, if that bad news were right in the end of December, wouldn't be a big deal. Why? Because the prices were already so beaten down, right? The prices matter. The prices tell you how vulnerable things are to whatever news is going to come out. If something's very beaten down and it turns out that bad news comes out, it doesn't affect it so much. If it's super high and bad news comes out, it gets beaten down a lot. Assuming, of course, that the market doesn't shrug it off with euphoria and, that exhausts itself at some point in time. This is basically due to the buildup of debt, change in price, especially rate of change of prices. In other words, buyers are already in the market, and you're in a situation where people are going to naturally have a psychology that has forced them to sort of overextend. You just think about somebody who's reaching somewhere and they fall, right? They're overextended. Same sort of concept here. So this is the biggest thing that I'm expecting, and I would pay attention to. I would try and pay attention to what are the instabilities of the market. And you'll notice that the market becomes unstable when it moves very quickly in one direction or another. It becomes unstable when people become levered up with quite a lot of debt. It becomes unstable when narratives get far ahead of realities. It becomes unstable when too many buyers or too many sellers have taken action, so hence there's just not the proportional amount of them to come in. And the tendency is to return to some sort of stability of buyers and sellers. And so what is my sort of prediction, or what am I doing at the moment? How am I playing it? So as I mentioned kind of since sometime in the fall, I was buying risk-on assets, dollar cost averaging in. Those are up quite a bit right now, which is great. That's lucky for me, we'll call it that. Probably luckier than I deserve in that regard, because certainly it could have continued longer. So I will intend to sell into that rally. I expect to see some pullbacks because things went up a lot. I do not think that it will reverse immediately. Some people seem to think that we're going to get negative earnings data and negative Fed data, and the market is going to take quite a dive, and we're going to see new lows, and that's possible. It's not entirely impossible. But I don't think that's the case. I think that you've essentially seen the maximum amount, at least in these types of assets, right? We're talking about like small cap growth, crypto, etc. We've seen things hit fairly hard. And as a result, I would expect that we'll have a pullback, but that it will ultimately resume. That fundamentally the next, let's call it 3 months, probably are going to be fairly decent. And that at some point that will overplay itself. If I was to guess, I would think that Bitcoin will probably get to somewhere between 30 and 40,000. We'll see. Maybe it goes higher, maybe it doesn't get there, but that would be kind of my mental model of what I would expect. And as a result, I would expect to take profits on that, recognizing that I could miss out on the opportunity. Maybe it just continues on, does amazingly well. What would cause me to change that belief would essentially be if you had, for some reason, a Fed pivot, so not a Fed pause, but a Fed pivot, lowering interest rates, stimulating, etc., while the economy did fairly well, which I think it's very irrational to think that would happen. But if it did happen, I would think that would be the case. Or if just at least they kind of softened, maybe not are actually totally stimulative, and you ended up in a situation where the economy did really well. Or I guess you could use the extreme, which is prices stay fairly high, the economy deteriorates a lot, and its prices still haven't gone down, and the Fed pivots. Those are basically my scenarios under which I would think that it would continue. I could be wrong, right? Keeping that in mind. It's entirely possible that I'm off. So what I'm sharing with you is not what you should do. You should do whatever works for you. I'm sharing with you what I am doing in terms of my outlook, because some clients were reaching out and asking my perspective. And so I will sell out into essentially low volatility, high liquidity, yield-bearing assets. So I did a video on bonds a little while ago, moving into assets like that. I still have a fairly substantial amount of cash and, earning me yield, but I'm also fairly invested in terms of general risk-on assets. And so I will work on rebalancing towards the rest as things go up, if they go up. And then I will expect a pullback, and then I will expect to re-enter. And so that's my thesis. We will see if I'm right or wrong. Obviously, there's some people who would suggest that time in the market beats timing the market. If you can not time the market, that's true. And timing the market's incredibly difficult. So I don't necessarily think that many people should do it. But this being said, I think that if you start to think about it from the perspective of structural instability, and I feel like structural instability sort of leads technicals, although it does show up in price action to some extent. then you can have some idea, at least when you're at the extremes. In the middle point, it's really hard to tell what's going on, but at the extremes, it's possible to see. I mentioned before, when girls were tattooing Doge on their ass and putting it in Instagram, I was like, oh boy, this isn't good. So those are some thoughts. Let me know what you guys think, and I will look forward to seeing you on the next video.